we had another question we wanted to cover.
Yeah, John from Alpharetta asks, roughly, how do the inflation protection mutual funds work? Do you recommend them, and what are some alternatives? So inflation-protected mutual funds hold Treasury inflation-protected securities, also referred to as TIPS. Those are Treasury securities that are indexed to inflation to help protect investors from the negative effects of inflation. So TIPS seek to protect you from the negative effects by adjusting the face value of your bond. And this isn't just to say if inflation goes up by 2%, you're going to get a full 2% higher on your bond. It's actually indexed by some set rate by the Treasury. So as a result of this adjustment, your coupon payment is going to also be adjusted up. But to get to your question about whether or not we recommend them, TIPS funds took a hit in 2013, posting their worst year on record, and they were down about 8.6% on average.
That hurts on a bond investment.
No kidding. Yeah, something you would think is there to protect you, and you lose 8.6%.
Right.
We don't recommend TIPS for our clients right now, as recent inflationary data still shows inflation is pretty much in check at just 1.1%. So we believe that if you're concerned with inflation, investing in stocks is still the way to go. Specifically, you can invest in consumer staple stocks, and we go with this sector in particular because typically consumer staples can pass along those inflationary costs on to consumers a lot easier than, say, some of your more discretionary needs.
And stocks that are increasing their dividend, too.
Yep. Yeah, absolutely.